I'm Justin Turner. I head up strategic partnerships for our logistics vertical globally. My role is to define and execute the global logistics strategy, but also work with our partners to ensure that they can offer protection to their global customers. So we're going to talk today about how embedded insurance in the logistics industry through shipping platforms allow merchants to access insurance products for their goods in transit at a time and a price that is appropriate to them. Embedded insurance distribution in the logistics industry is being able to offer an insurance product at the time that the shipper is making a booking. So what is important about that is that the goods that are in transit can be covered for the actual value of their goods, rather than traditionally where you would have an annual insurance policy purchased by a broker. So importantly, with the growth of e-commerce over the last 5, especially 10 years, so too has the customer wanted to have choice in how they receive their goods that they've purchased online. So with that has been an increase in shipping platforms that are able to offer a multi-carrier service. So offering a multi-carrier service, which gives a consistency amongst the delivery process, you would also want to have protection that is consistent with the products that you're shipping as well. Traditionally, couriers would offer a warranty product, which may include a fixed amount, or they may offer to sell insurance at quite a high price. And that all those offers are different. So embedding insurance across a platform, a shipping platform in e-commerce is extremely important these days. So embedded insurance in particular products where you can protect the full item value of the retail value plus the reshipping costs allows the shipper to resend those goods that may have had something wrong in the delivery, such as a lost in transit, without losing their margin. So by being able to ship that out immediately that there's an issue, the consumer has a trust with that platform, that retailer, that they're using, because they know that when they're buying online from this company, they will get the goods delivered in a timely manner or at the time that they choose or the place that they choose. So that trust goes a long way to sort of creating conversions or adding sales. Yeah, so protection gap as a term, what that means is that traditionally a shipper or a merchant, if you want to call them that, would go to a broker and purchase an annual policy under a marine cargo. Now, what you would have to do is you'd have to estimate the amount of goods that you were going to ship in a 12-month period, and a premium would be applied to that. Now, the protection gap means that you could be underinsured or overinsured. So underinsurance would be something like you have offered that you are going to ship a certain amount of X products in the next 12 months, but the policy may not include the final mile distribution. So therefore, for that last leg, you aren't covered. Or alternatively, you've decided to launch a new product line, which you hadn't advised your insurer originally. Now that new product line may not be insured either. So there's a protection gap there of being underinsured. To be overinsured means the same thing. So what's happened is you've estimated what you're going to ship in the next 12 months and you've paid a premium. However, there could be some external factors, COVID being a great point in the last 12 months, where you lost some sales or you lost orders from a retailer and you're a wholesaler. So therefore you've paid a premium on goods that you're never going to ship. So that's being overinsured. And what embedded insurance allows for goods in transit is that when I talk about the right product at the right time at the right price, it means you're actually paying a premium for the goods that you have in transit. So you're not estimating, it's specific for what you're covering. So you're always protected for the goods that you ship. Shipping platforms are asset light. So they tend to sit above the courier networks who are very asset heavy, right? So with that asset light model, for them to get scale, they obviously want to grow internationally. So when they enter new markets, what they don't want to do is have to worry about sort of other areas. They want to focus on core issues. So being able to have a partner that can pay out claims in markets in which they're operating is going to take away completely that sort of ancillary burden for them and allow them to focus on core business as they grow into new markets.